Hey guys, it's Carter. Welcome back to the channel. Hope you guys are all having a fantastic day today. Now, in today's video, we are going to be talking about the best ETFs you need, the best that I have, and that I would highly recommend having going into the new year. You need a base of core, a nice core growth, income, diversification. All these are crucial for your income. And we're going to show you guys the ones that we have so you guys can kind of see my approach, guys. So follow, and if you want to learn more about investing, trading, check out our school. We got a Black Friday sale going on, code Black Friday for 51% off, one of the largest sales we've ever done. So check it out down below and let's dive into this. So for those of you that don't know what an ETF is, an ETF stands for an exchange traded fund. Simply, guys, it's a pool of companies that are into one price, essentially, right? It's a pool. So you're getting a little bit of each, right? Imagine a huge pie, and each slice is a company. So as the companies grow, the sectors grow, whatever the ETF focuses on, because you can have different ETFs focus on sectors like energy, or you could have them focus on indexes like the S&P 500. So let's talk about the best one starting off. You need a nice core one, a nice base, a nice foundation. So this is where I always go, the S&P 500, VOO or SPY. Huge upside for a nice foundation. The reason I love it, over the past 90 years, we've seen an average growth rate of about 10%, meaning if you just invest today, tomorrow, or in a year, right, you have the long-term outlook that is huge, right? Because you understand that this is going to compound and grow. Now, another reason I love it is because companies constantly get added to it and taken away, which for us, that's awesome because they're only choosing the top 500 top 500 companies. So if a company does not meet certain qualifications, they get withdrawn out of the fund essentially. So great growth, 10% per year, plus some nice dividends as well. Right now we've seen some icons like Nvidia, Apple, Microsoft, Tesla, Amazon, a lot of other really great companies, but it also has a lot of other different sectors. So it's really important for nice diversification. Okay, the second ETF, I'm going to go growth. So meaning I'm going to be able to take a little bit higher risk and a little bit higher reward. So imagine this ETF for like a huge upside. I'm going to go QQQ or another similar one. The reason I love this is QQQ is more of a Nasdaq tech heavy ETF. So I'm a firm believer in AI and, artificial intelligence and quantum computing and all of those other, high risk, high reward companies. That's what QQQ focuses on. We've seen some great growth. It historically has beaten the S&P 500 and the growth per year, but on those downturns, like we saw earlier this year and in 2020, QQQ sells off a lot quicker because growth stocks historically, are a little more volatile, but they carry a lot of potential here. The next one is I'm going to go more international. So I'm not going to be just only investing into companies that are US based. This is important because if that's just say the general stock market got tanked, right? We've seen tariffs or, just a crash, right? Which happens. If you're only investing into the United States companies, you could get hit hard on this. So being an international ETF like IEFA is a fantastic ETF. Now, the con to these is they don't grow as much, which for me, I don't go heavy in it. I almost use it as a leverage of cash. Let me explain what I mean. So if I'm investing into this ETF and the market sells off like crazy, I'm going to actually sell some of my international ETF and buy more of the S&P 500 or more US based. I almost use it as a hedge against the US, but nevertheless, it's still good to have in your portfolio. Now, the last and final one is going to be an income based ETF. So I always love like SCHD, which is a Charles Schwab dividend ETF that tracks the best dividend companies out there. You get decent growth. It doesn't grow as much as QQQ or the S&P, but where it makes up for it is going to be dividends. So you'll get about 3% per year in dividend appreciation and cash flow coming into your account, which is kind of why I invest into it is for that cash flow. So these are the best ETFs that I am buying. But the biggest thing is each one is different. Each one is going to be focusing on different goals that I have. So maybe you guys want more cash flow, so you'll go SCHD a little heavier, or more. Maybe you're young and you want to carry a little more risk. That's all fine because we all have different goals. So I hope you guys all enjoyed this. Smash that like button, subscribe, check out our school, and we'll see you guys in the next one. Take care.